Hey, congratulations. You're trying to buy a home, right? Well, that's probably why you've poked around and found this video. So welcome. My name is Christian Berrio from the Homebuyer Learning Center, a division of United Mortgage. In this collection of videos, you're going to learn the necessary steps to become a homeowner. Some of these steps might be unglamorous or kind of difficult. You might not know how to navigate through becoming a pre-approved home buyer. So in this collection of videos, we're going to show you those steps. The first thing we're going to address is your credit. What credit do I need to qualify? What are good credit behaviors? How do I repair my challenged credit? In our second video, we're going to discuss the mortgage pre-approval. Once your credit has been established and we know what we can lend based on your credit rating, now we have to understand how much money you can afford to pay. So we're going to go through the process of understanding your income, your assets, and the type of loan that you would qualify for. In the third video, we're going to discuss how to find a realtor. What realtor is the best for you? How much does a realtor cost? What's a realtor's job and duty? In the fourth video, we're going to discuss your attorney, the legal matters that are tethered with buying a home. What is title insurance? How do I prepare and understand my contract? What money might be at risk if I try to buy a home? In that video, you'll have a real in-depth understanding of what your attorney can do for you and what their role and obligation is. In our fifth video, you're going to learn about inspections and appraisals. What's the difference between an inspection and appraisal? What are the costs of an inspection and appraisal? What information can you get from one versus the other? And in our sixth and final installment, we're going to talk about the closing. Well, I hope you find these videos helpful. I wish you all the success in homeownership. Happy house hunting. Hi, Christian Berrio with United Mortgage's Homebuyer Learning Center. And in this video, we're going to discuss credit. You might be wondering, what's a qualifying credit score? What does my credit need to be? Some of you watching this video might have 500 credit, and some of you might have 800 credit scores, and really not sure how this difference in credit really impacts your mortgage loan or the buying process. Well, I'll tell you this, whether you have 500 credit score or 800 credit score, we have the plan to get you there, to make you a homeowner in 2021. So let's get right into it. The first thing you need to understand about credit is, how is it scored? How is your credit score determined by Equifax, TransUnion, or Experian? Well, they all use very similar algorithms. A proprietary mathematical equation that takes your credit information and gives us a number about your credit behaviors. So some of these algorithms are really just about figuring out how they get there. So we've learned that one of the best and most impactful algorithms to understand is utilization. Utilization means how much of your credit limit are you actually borrowing. So I find that these things are the best to explain in an example. So let's say you have a $1,000 credit limit on your credit card. If you had a balance of $400, your utilization is 40%. So what's the right number? What's the right utilization? They want to make sure that your utilization doesn't really exceed 35%. Now, that doesn't mean you can't borrow and use your credit greater than 35% of your limit, but what happens when you do? These are the things that are game changers when it talks about elevating your credit score or impacting your credit score. So any utilization greater than 35%, somewhere between 35 to 50%, will actually have no impact. It's really not going to move your score very much. If you have utilization lower than 35%, we've done really good here. That's the golden rule. Try not to use more than 35% of your credit limit. If you maintain a balance less than 35%, your credit score will increase, and it'll increase quickly. If you breach that 50% number, Let's say, same example, you have a $1,000 credit limit. Now you start borrowing $600 and $700 from that credit card. That's when you're going to see negative impact on your credit report. So the best thing you can do is bring your utilization down to sub 35%. Now, don't get ahead of yourself. A lot of people think, great, I'm just going to pay it off. Let's get it down to zero. That's a recipe for disaster. See, the algorithm measures your ability to pay back. Well, if you have zero balance, there's not much to measure. So a 0% utilization actually does nothing at all to your credit. It's about measuring your ability to pay back. So keep your utilization in between 1 to 35%, and you'll be golden. You'll see improvement right away. So are you concerned about your credit because possibly you have some judgments, some collections, maybe some liens? So this is how you can address some of those items. Firstly, we need to understand the impact that a collection account has on your credit. A collection account is going to have an immediate impact. You will see a drop in points, sometimes 20, 40, and even 60 points when you get a new collection account. So you might be thinking, the first thing you want to do is pay it off right away. Well, slow down. I don't want you paying that account off. Well, namely because medical collections, by way of mortgage pre-approval, don't have to be paid off. That's right. You can have open medical collections and close on your home loan. So it's not critical to pay those off. So I don't want you spending money that you don't have to. If you have collection accounts from old credit cards, or perhaps a cell phone bill, or some old debt, then you're going to want to have those things paid off. That doesn't mean hurry up and pay them to zero. I would encourage you to call your creditor. Your creditor wants to hear from you. Don't put your head in the sand like an ostrich and hide from it. You want to become a homeowner. And the only way to do that is to attack your credit issues head on. So contact your creditors. Let them know what you're going through. If you had a hardship, explain it to them. They might be able to settle with you. Maybe settle for less, or come up with a payment plan that you can afford. We want to address it, but we don't want you to do something that is going to further negatively impact your credit. So open a dialogue with your creditors. Another strategy to improve your credit is to add yourself as an authorized user on somebody else's credit account. This can be anybody. This can be a friend, a family member, a sibling, a child, a parent. And what you want to do is you want to understand their credit behavior specific to that account. If they're going to clip you on as an authorized user to one of their credit card accounts, you want to make sure to ask the 3 critical components to make sure that you're being added to a healthy and positive credit account. So the first thing you want to know is, how long has the account been established? The key number is 24 months or greater. Secondly, the utilization. We talked about how important that is and how much that can drive your score up. So make sure their utilization is around or below that 35% number. And lastly, you want to make sure that they pay that on time, all the time. If you can say yes to all those questions, that's a great credit account to be clipped onto, and you'll see amazing improvement in your credit rating. Now that you understand how to get qualifying credit, we're going to talk about the mortgage pre-approval process in the next video. See you then.
In this episode, we're going to talk about mortgage pre-approval. Now, you've already done the work of preparing your credit and getting your credit score to a qualifying number. Now, we're going to help you to determine how much money you need to purchase a home. Did you know that most people think they need 20% down to purchase their first property? That's not true. You actually only need as little as 3 or 3.5% down. And for some of my veterans out there, the veterans of the United States military, you have the ability to purchase a home with 0 money down. That's right, 100% financing. Now, does that mean you can buy a home with no money at all? That's not exactly true. You still need to cover closing costs and certain expenses as it relates to getting your loan transaction wrapped up. So in this video, I'd like to talk about some of those things and how you can qualify to get a home loan. And what is the process to get pre-approved for a mortgage? Well, you're doing this, right, to buy a home. And the first thing you want to do when you're buying a property is to go see property. But you might be finding that if you're speaking with realtors, they don't want to show you homes if you're not pre-approved. And it's not so much that the realtor doesn't want to take you out and show you homes, but there's many reasons why you cannot do so if you are not equipped with a bank mortgage pre-approval. Number one, sellers do not want to let would-be buyers into their home unless their finances have been confirmed. And that is in the pre-approval. How do you get a pre-approval? We have to assess your income, assess your credit, assess your down payment. And depending on the type of loan program you're going for, we will issue a pre-approval document to your realtor. That document grants you access to see all the properties that fit your criteria and your financial needs. So let's talk about your financial needs. When we talk about mortgage pre-approval, we like to reverse engineer affordability for you. Here at the Homebuyer Learning Center, the last thing we want is for you to be house rich and cash poor. So we want to understand what is your monthly affordability. And then we're going to reverse engineer a price and property taxes that line up so that you can see the right homes with the right real estate agent. So what I'd like you to think about in depth is, what mortgage payment can I afford? By understanding what mortgage payment you can afford, we can then back into the amount of home that you should go out to purchase. Your affordability is actually calculated by a very specific set of numbers. And this set of numbers is called the debt to income ratio. How much debt do you have compared to how much income you have? And so we can make sure that you can afford a home, but it does not breach the debt to income ratio allowance to purchase a property. And this is designed to protect you, the would-be home buyer. Because even mortgage regulators and the Department of Financial Services does not want you to purchase a home and be in a tough way of trying to afford it, right? You want to be able to buy a home and you want to enjoy your home. You want to have money to still go out and maybe paint the house and buy furniture. You don't want to purchase a home and then have to be a slave to making those payments, and you really can't enjoy life. So by coming up with the proper debt to income ratio, we will be certain that you are not overspending your income just for your home. During the mortgage pre-approval process, you might wonder, how much is this going to cost me? Well, we already know what 3.5%, even 5 or 10% down is going to cost, right? A quick demonstration. If you're buying a $400,000 house, 3% is about $12,000. If you're putting down 10%, that's about $40,000. And if you're putting down 20%, that's $80,000. Now that's the down payment in the house. That gets you the equity position that you need to purchase a home. Quick little sidebar, what's equity? Equity is the amount of your home that's actually paid off. So if you put down 10% into your home, $40,000 in this example is paid off, and your loan amount would be for $360,000. So how can you put down 10% or 3%? So let's talk about what money is usable. You can use your own checking or savings accounts. You can use 401k and retirement accounts. You can use annuity or any different type of financial asset like an E-Trade account. You can even receive gift money. So let's say for some of our younger buyers, perhaps you have a parent who's willing to help you out and get started in your life, and they're going to give you some money to help you purchase a home. You can actually use that money legitimately as a down payment on your property. There are a few very distinct types of loans that you can get in the marketplace today. You might have heard of these three infamous names: FHA, Fannie Mae, or Freddie Mac. And these names might confuse you. You're not really sure who they are or what they do. A lot of people think that they're lenders. Matter of fact, they're not lenders. They are insurers of mortgage loans. They provide the guidelines for us lenders to provide you money and to give you a loan. So if you were going to purchase a home using an FHA loan, that's the product that allows you to purchase a home with as little as 3.5% down. If you're going to put more money down, you might want to entertain what is called a conventional mortgage. In other words, a Fannie Mae or a Freddie Mac mortgage. These mortgages have an added advantage in that if you put a little extra money down, you will have a lower and cheaper mortgage payment as a result of less PMI. Now, I didn't mean to throw you for a loop there. You're probably wondering, what's PMI? If you do not put 20% down on your home loan, you will have to pay an additional insurance every month called PMI. The more money you put down, the less amount that insurance is. And the less amount that you put down, the higher that number is. So if you can put down more money, up to 20%, you will not have any PMI. You don't have to suffer that additional payment. But if you have less than, it doesn't mean you can't buy a house. It's glorious that these insuring agencies, FHA, Fannie Mae, and Freddie Mac, still make it possible for someone like you to buy a home with 3 to 5% down. The mortgage pre-approval process is where you start gathering documents. I'd like to take a moment to talk about what you want to prepare for your conversation with your loan officer so that you can actually get a pre-approval as fast as possible. The loan officer is going to certainly run your credit. And in our previous videos, we talked about how you can help to improve that. But what else do we need to get you a pre-approval? Well, if we're going to put in writing that you're approved for a loan and that you can go out and shop for a home, well, then we're going to need something in writing from you. And what is that? We need your income documentation. You're likely going to be asked for your 2 years of tax returns, your pay stubs, your bank statements, and your W-2s. With these items, we can verify the income that you have, what's usable so that we can get you a home loan, and then that's going to actually tell us how much you're pre-approved for. So make sure before you contact one of the loan officers or you contact a counselor at the Homebuyer Learning Center, make sure you're gathering your documents and getting that stuff together because we may ask for some vital information regarding your income. It's this vital information that allows us to validate and assure that your pre-approval is ironclad and ready to go. Let's talk closing costs. Many of you may be wondering, okay, I saved up my $12,000 to $20,000. I'm ready to go. I'm ready to buy a home. But how much does it cost to close a loan? And you might be right. There is actually some cost in purchasing a property. Sometimes you can spend more money on the cost than you do the down payment, depending on, of course, what loan program you take. Certainly, it should be true with our veterans, right? Veteran, you can buy a home with zero money down, but you're never going to buy a home with zero cost. So you still have to prepare yourself to have those costs ready to close a transaction. You may have heard the phrase, it takes a village. It's very, very true. There is a number of costs that we as the lenders have to convey and share with you. We have to, it's kind of like a don't shoot the messenger. It's our job to present these costs to you, but we are not the person that's taking all of these fees. There are third parties that get paid throughout the entire process. One of the most expensive and most important fees is that of title charges. Well, what is title? Well, when we buy a car, we understand there's a title attached to that property. Well, that title will have on it who you owe money to, who is liened against this. It is very important, it's actually critical that when you buy a home, that the deed is transferred to you clean of any old debt, any old judgment, any old violation. And the title company is the insuring agent that will protect you. And that comes in your closing costs. So you can see quite a bit of money there. There are deed searches and municipality searches and local township costs. There's even state tax. When you purchase a home, you're going to pay state tax. You buy a shirt, you pay tax. You buy a home, you pay tax. And that's not a small number. So just don't shoot the messenger. It's our goal to make your home purchase the most affordable and use the least of money out of your pocket. All right, so we've done it. We understand that we can buy a home with as little as 3% down, and for our veterans, maybe even zero. We also have to save some money for closing costs and be prepared to pay those things, right? Well, before you click that button to speak with a Homebuyer Learning Center counselor, I would urge you to think about your affordability. Make sure that the conversation you go into is about what you can afford every month. Just keep in mind, no matter the price of the home, you don't pay the price of the home every 4 weeks. It's the mortgage payment that you have to live with. And we at the Homebuyer Learning Center only want you to have a home that you can live in comfortably and you can afford. Buying a home is the most exciting time of your life, and we'd love to make it easy on you. So if you're thinking about getting pre-approved, click the link below and a Home Buyer Learning Center counselor of United Mortgage will be reaching out to you right away, and we can talk about your affordability and reverse engineering a loan that you can afford. Christian Berrio signing out, and I hope to see you in your new home soon. Good luck.
Hey guys, and welcome back to the Home Buyer Learning Center. In this video, we're going to talk about the benefits of using a licensed real estate professional. If you've been checking out our series, you've probably done some credit work. You might have even gone through the pre-approval process, submitting documentation, understanding your affordability, and congratulations if you have. But now you're ready to see properties, and this is really where the fun comes in, right? You've done all the messy work and all the paperwork. Now you want to see homes, and you want to try to find the home of your dreams. And we're there for you. But you might be wondering, what does it cost to get a real estate agent involved? You might not want to spend any more money than you have to, and I respect that. Well, good news for you is as a buyer, you're not responsible to pay your real estate professional. As a matter of fact, the seller pays the real estate agents that are involved. So what you can do is you can take your mortgage pre-approval, provide it to a real estate agent, tell them all of your criteria, your entire wish list. Bedroom count, bathroom count, basement, garage, yard size, location, location, location. And a real estate agent and a professional in that market can show you all the available listings. They use what's called a multiple listing service technology, where in your email you can receive regular updates to price changes and homes that fit your criteria in your area and in your market that you're looking for. And it doesn't come at a cost to you. So you get the help of a professional to take you out, to present your offers to the sellers and get you into a contract to purchase that home. Using a real estate professional is tremendous, and it's very much recommended. We at the Home Buyer Learning Center work with a great network of real estate professionals, and we'd be happy to pair you with someone in your market. Now you're prepared, right? You've done your credit, you've pre-approved yourself, now you're working with a realtor and you're out shopping. I wish you all the luck in the world. Go out there, see the home of your dreams, find the home of your dreams, and fight for it. We'll be here for you to help you get from contract to close. Check out our next videos. And if you have any questions, certainly click the link below, and a Home Buyer Learning Center counselor will be in touch. I wish you all the best, happy house hunting, and make it fun.
What's up everybody? Thanks for checking into the Home Buyer Learning Center, and in this video we're going to talk about your attorney and title insurance. Congratulations, you've made it really far. We've done all that crazy work, right? We've checked out our credit, we make sure that we credit qualify. We've pre-approved ourselves with a mortgage and a financial institution so that we know we can afford a home and we know how much home we can afford. We've been paired up now with a realtor showing us properties in the areas that we want to buy a home. We've gone through the process of getting an inspection and an appraisal, and we understand the value of really wrapping our brains around the conditions of the property. What's that mean for you buying the home? Now, you need an attorney. You need someone to write the contract and negotiate these items based on the inspection and set you up with a reasonable closing time frame. The attorney is also going to make sure that the title, the certificate of ownership, is transferred cleanly from the previous owner to you. And title insurance happens to be one of the most expensive components of the closing cost. So you want to make sure, because it's incredibly important, that you are being in receipt of a clean and clear title when you purchase the home. Well, what is a title? How does a title work? Well, you might have some experience with a title with your vehicle, right? If you've ever bought a vehicle in the past, you get a little blue slip or a pink slip. And this information has the details of the property, the kind of make and model and vehicle it is, who owns that property, and who has a lien against that property. If you buy a vehicle, of course you want to receive that title clean and clear of the previous owner's name and the previous debt. Well, a title on a property works just the same. The difference is there's quite a bit more that goes into delivering a clean and clear title on a property than there is a vehicle. A title is recorded with the local township. The local township keeps record of any debts, liens, violations, certificates of occupancy, any town recorded debts or issues with your property is recorded against your deed. It's incredibly important that when you buy a home, you buy it free of any issue. So your attorney will work directly with the title company to clear any of the seller's previous condition issues. Once the property condition and the title has been cleared, we can move towards closing your loan. It's an incredibly important part, and the attorney and the title clearance might happen in the second half of the transaction, but it's critical to getting your house delivered to you clean and free of any issues. So for this video on title insurance, if you have any questions, you can certainly reach out to any of the Homebuyer Learning Center counselors. You just click the link below. We'd be happy to help you and serve you. You can certainly check out the rest of the videos with the full content of how we can help you to get into a home. From Christian at the Homebuyer Learning Center, a division of United Mortgage. Thank you very much for checking out this video. Hope to hear from you soon. Good luck and happy house hunting. Hey guys, and welcome back to the Homebuyer Learning Center. Thanks for checking out our series of videos. And in this video, we're going to talk about inspection and appraisal. What are the differences between the two, and when do you have to get them? So you might have checked out our videos to date, and you would have seen our credits video on advising how to improve your credit, how to get a qualifying credit score. Next, we talked about getting you pre-approved for financing, making sure that you can afford the homes that you're looking for, and what are your target financial goals. We then would pair you up with a realtor so that you can see properties that fit those criteria. And now, if you've made it this far, you've probably found a house. And congratulations, it's really exciting. But what next, right? We want to go into contract, we want to buy this home, we want to close, we want to move in. But you probably don't want to do that before you check to make sure that the home is in great condition, or at least good condition. It's very common that we're buying homes that are used. Not every home that we buy is new. So a used home should get an inspection. You want someone to do an all points check to make sure that the home is sitting on a good foundation, that the roof is not leaking, that you don't have any mold or any major issues to consider. And who can do that for you is a home inspector. Quick little tidbit, home inspections are not required by the banking department. You do not need a home inspection in order to get home financing. You do need an appraisal, and we'll get to that in a second. So let's continue to talk about the inspection. What a home inspector can do for you is they're going to come to your home prior to you going into contract, and they're going to check the condition of the property. They're going to check for efficiencies in the boilers, efficiencies in the heating and cooling systems, efficiencies in the windows and doors, the siding, the roof, the foundation, and the overall condition of the property. They'll oftentimes check for things like termite damage or infestations of anything like that. So an inspection is really great because it's going to give you basis for negotiation. For example, if you notice some water damage in a basement, it might not be a reason to move on from the home, but you might want to consider some remediation. You might want to get that water seal. So these are some of the things that an inspector can make you aware of so that you can go back to your realtor and your attorney and you can negotiate with the seller some concessions or an adjustment in price for these issues. If the inspection goes well, then fantastic. You can go ahead and make your offer with no necessary changes. But an inspection is really great, and you can expect an inspection to cost anywhere between $400 to $650, and that's a pretty wide range, but there's a number of different types of properties. When I talk about $400 to $650, of course I'm talking about a single family residence here in the greater New York State area. If you're buying property in a metropolitan area and it's a multi-unit home, you might find that inspections can cost upwards of $1,000 or $1,500. So you want to make sure that you don't take lightly ordering inspections. You're going to spend good money on houses that you're not yet contracted to buy. So make sure that when you're very much interested in the house, you get an inspector in there to tell you what is going on with this home, good, bad, or indifferent, and it puts you in a power position for better negotiations. So now we're going to talk about post-inspection. Let's say everything did go well, and now you're ready to enter a contract. Well, you go into contract and you go to buy your home. One of the first things that the lender is going to do is going to order an appraisal. Well, the difference between an appraisal and inspection, though they both are actually inspecting the property, they're to two different purposes. The purpose of the inspection is to let you know about the condition issues of the home. The purpose of the appraisal is to tell us, the lender, what is the value of the collateral? What's the value of the house? When you take all of the inspection details, bedroom count, bathroom count, square footage, property condition, what does that mean in dollars? And what does that mean in the value of your home? And an appraisal is a required part of your mortgage process. So, to surmise, an inspection, not a needed part, but vital when it comes to understanding the condition of your property and how you're going to set yourself up for negotiating the price. And an appraisal is a needed component of closing your transaction, as it tells us the value of the collateral that you're buying. So I hope this was really informative, the difference between an appraisal and an inspection. And now we're moving on to dealing with our attorney. What is the process of closing? What does an attorney do for you? So check out the next video. Of course, guys, if you have any questions about the content of this video or any of the information that we're sharing with you along our series, don't hesitate, of course, to click the links below and continue to surf some of the information that we have for you. Guys, from the Homebuyer Learning Center, an office of United Mortgage, thank you very much for checking in. Good luck and happy house hunting. Hey guys, and thanks for coming back to the Homebuyer Learning Center. Thank you for checking out this series of videos. And if you've come this far, you've probably done a good bit of work. In this video, we're going to talk about the closing and what you can expect and what you have to bring. So, if we've gotten to the closing, we've done a number of things, right? In the past videos, we might have seen how to repair and how to get qualifying credit, how to get pre-approved for a mortgage, how to find a realtor in your neighborhood, getting into contract, talking with an attorney, getting an inspection and an appraisal, submitting your loan to underwriting. So we've come very far. And now we're ready for the closing. The closing is imminent. So one of the things that you're going to do is you're going to do a walkthrough right before you close. The last time you saw the house might have been a month or two ago. So now it's time to make sure that the house is in good condition so that when it's delivered to you, it's delivered broom swept and clean. You want to make sure that the sink is still functioning, the heat's still working, the door is still open and closed, and the windows work right. So your realtor is going to take you to the walkthrough. And this will normally happen about 1 day before your closing. So after a successful walkthrough, you will be able to go to the closing knowing that the home is being delivered to you broom swept and ready to move in. Well, if there is anything like a hole in the wall, or maybe they scratched or dented something on the way to moving out of the house, have no fear. That's not going to hold off the closing. That'll be discussed at the table, and sometimes some concessions or some credits might be given back to you at the closing to accommodate. Your attorney is going to call you the day before closing and let you know exactly how much money you need to bring in a certified check. You might be wondering, what do you need to bring to closing? Well, the best thing to do is bring your wallet, bring your identification, and bring your checkbook. Little pro tip is that some of these adjustments, based on the walkthrough, might result in moving a couple of dollars here and there that weren't discussed or negotiated prior to closing. So that's it. We've done it. Congratulations. And I want to thank you for making us part of your journey. If you found any of these videos to be helpful, please feel free to share them with your friends and family. Well, now you've closed. You probably got to get pretty busy moving and packing boxes. Congratulations. I'm so excited for you and your family. Christian Barrio signing out, and you're a home.